All right, everyone. Thank you for being here. We appreciate you taking time to hear more about our investment opportunity with Vista Del Sol in Fort Worth, Texas. We're really excited about it, and we feel like it's a really compelling investment, specifically in a well-maintained, stable property. And we'll talk more about all those details. But I want to start off with this, and the reason is because we realize that real estate investing, while it is tried and true, building wealth for individuals, it's a great asset to own, specifically during tough economic times. It's resilient. It's really about the people that live in these properties. It's about the people who invest with us. And so this is a people-first business. That's the approach we take. And this is a great memory that I have where Jason, Ryan, and I, the three partners of Common Capital Investing, took a Saturday, went and picked up a playground and put it together on the property. And literally right when we were done, these kids started playing on it. And it was a really great feeling to see how we were able to improve the property, but not only that, but give a place for these kids to play, whereas before they didn't have that. And so we always think about this. We think about how do we improve the experience and how do we improve the lives of the people living in our properties, and how do we improve the lives of the people that invest with us. We take that very seriously. A quick disclaimer, this is a 506c offering open to accredited investors only at this point. And do your homework on real estate investing. We'll offer you as much information as possible to help you make a decision, but past performance does not guarantee future performance. And of course, ask as many questions as you feel are necessary to make a good decision. Quick overview. So Vista Del Sol, an apartment complex in Fort Worth, Texas. It's actually in Southwest Fort Worth. We'll get into the details on that. And we call this it's workforce housing. This asset class, usually older asset classes, are typically well positioned for the workforce community. And that's typically what you get in this community. And that's really specifically what we invest in. We believe, and we have an investment thesis around affordable housing and providing good quality affordable housing for the workforce community where there is a demand. Minimum investment is $50,000. Of course, this is a 506c offering. And then some projected returns. One of the things that's interesting about this property, we'll get into it, but it is a stable property. It's at 95% occupancy, or maybe even more at this point. We review those rent rolls every month, and it's performing well. And so we're buying a property that is stable. We expect it to cash flow day one, and those projected returns are based on the current operations, but additional value that we can add as we operate it. And again, we're going to take advantage of, like we have in our other properties, of cost segregation, bonus depreciation, and all those tax deductions then flow through to us and the investors in this property. We'll talk more about those details. Here's a little bit about us. So again, I mentioned the three of us, we put together that playground. There's a little picture of us doing that on property. We like to get our hands dirty when we need to, but we also have a lot of partners, both property management, contractors, those sort of people. But when we can get in the mix, we sometimes enjoy that. But we believe in triple bottom line investing. So people, profit, planet. It's not just about profit. We want to do the right thing for the people living in the property, and we want to do the right thing to make sure we're efficient with the resources that we have. Low flow toilets, even when we can do solar. Ryan's a big solar guy, so we're always looking for those opportunities. And we want to create great communities and improve the quality of life. I think in this space, you see a lot of people that don't do that, and we want to be the differentiator there. We really want to invest in the people that live in our communities. We also invest alongside our limited partners. So we're putting our money in the deal. We call that skin in the game. And we have quite a bit of real estate experience. We've been doing real estate investing between the three of us somewhere around 48 years. I got my start in 2006 with my first flip. I saw 2008 and the sort of foreclosure crisis up close and personal, learned a lot of lessons. And so we own apartments, small multifamily, single family, and I'm a partner in a portfolio of multifamily, mobile home parks as well. Some people may be asking, the economy right now is a bit tenuous, but why should we invest in multifamily now? And really, it comes down to a few things. There's a lot of really great people that talk about this, a lot of economists and people that are much smarter than I am, and I listen to those people and I try to study what they say and study the markets. But really, what we're seeing is a supply-demand shift. So there's been a lot of supply when debt was really cheap. You saw a lot of people building multifamily. And the reason is because there's a high demand. We are still undersupplied as far as housing need for the US. So when debt was cheap, it was much easier to build. Those projects usually take 2 to 3 years. They come online. The reality is that most of those are Class A. There's not really a lot happening for affordable housing with new properties being built. So if you take that from a high level, there's still a supply-demand imbalance, specifically in areas where affordable housing is a need, which is where this property is located. If you forecast out, supply is actually waning. It's coming down because interest rates are high. So a lot of the properties that are coming online right now, those things started 2, 3, 4 years ago. If you forecast out 2, 3, 4, 5 years in the future, there's not a lot of starts. And so that supply-demand curve, or the trend is going to shift where there's going to be less supply and higher demand. DFW is a strong market. Do any sort of research you want, put that into Chat GPT, Google, whatever. You'll see that specifically Fort Worth in the DFW market, strong infrastructure, lots of growth, high demand for housing. Even though they've had good supply over the last few years, it's not keeping pace with demand. And then, valuations are down because interest rates have come up. If you know anything about cap rates have expanded. That means prices have come down. But if you look into the future, that is expected to shift where prices will go up. There's other reasons for that, specifically around people taking short-term debt and needing to get out of these properties. So there's more properties on the market right now. So we feel really good about investing in multifamily right now. If you want to talk any more about that, I'm happy to do that. But again, each of these we could kind of spend the whole hour on. Just highlighting this real quickly, John Chang, really smart guy, SVP of Research and Insights at Marcus & Millichap, which is a commercial real estate brokerage and debt firm, and really big here in the States. And why is this a great time to invest in multifamily? Because ultimately, the things I just said. But in addition to that, if we have a period of inflation, we have recession, hard assets are favored. And so you see a lot of institutional investors, big time people putting a lot of money into hard assets, specifically housing and multifamily. Again, do your research there, but pretty awesome stuff. So again, we're here to talk about Vista Del Sol. We're going to do some strategic improvements. We'll talk about that. Tax advantages, strong metro area, or a strong growing metro area with demand for affordable housing. And where this is positioned in Fort Worth is such a strategic benefit, and it makes me really excited to talk about that. It's in a single family neighborhood. It's next to an elementary school, middle school, and it is really well maintained and has been that for its life, really. Actually, it actually used to be student housing for the theological seminary, which is just down the road, and it became a private apartments, I think, in the early 2000s. So well-maintained facility, very like a commercial grade product. A few pictures of the property. It's a fairly large property spread over a pretty large area. You can see kind of there in the bottom left-hand corner. Really large parking lot, which you don't find with a lot of properties anymore, which we're gonna utilize. We'll talk about that here in a minute. So business plan. So year one, as soon as we close on this property, which is slated for the end of May, we have professional management ready to take charge of the property. There's a transition plan in place, and we're really excited about who our partner is, and we'll talk a little bit about them here in a second. We're going to implement RUBS. If you're unfamiliar, that's Ratio Unit Utility Billing System. This property is actually really well positioned for that because there's a commercial boiler, there's commercial heat and air. Everything is sort of centralized from a utility standpoint. It's not individual units. And so for us, that's an opportunity to create Ratio Utility Billing System. And there's a bit of an income stream from that. And so we're going to implement that. It's going to take us a few years to actually roll it out across all of the units, but we're going to start that on day one. The roof needs to be repaired. We already know we have an estimate for that. We're actually going to take advantage of doing a little bit more by coating the entire. These are flat roofs, and so we're gonna coat the entire roof on all the buildings. Just take care of all of that to mitigate any future repairs or leaks that are needed or the leaks that happen. There's some plumbing repairs that we're going to do specifically in the sewer. That's pretty normal for these age properties. So we do a lot of inspections in that respect before we buy it, so we know what we're getting into. We're going to add some covered parking, which will actually be a value add. So we're going to charge for that. It is something that the residents are asking for. If you know anything about Fort Worth, Texas, it's hot in the summer. There's hail in the spring. So covered parking is something that will be a good upgrade to the property. Implement water conservation. We talked about, people, profit, planet. So we're going to do, this is something we're going to do across the whole entire property where we implement, water saving faucets and shower heads and toilets so that we can save on water consumption, but also there's a benefit to that from an income perspective. And then there's security and lighting there now, but the current owner is going to take some of that with them. So we're going to implement new security, upgrade the lighting so that people in that property feel safe and secure and continue what is already in place. Year two. So you see a lot happening in year one, year 2 through 4, a little less, but we're gonna do what we call light upgrades on the units when somebody moves out. Right now it's 95% occupied, so this is going to take some time. That's why it's years 2 through 4, and we're going to triage each unit. This being an older property, there's various levels of renovations that have been done to each unit. There's a unit that's super nice, and we'll show you a picture of that in a minute. And then there's ones that we call classic that nothing really has ever been done to other than paint and repairs. So we're going to triage those as needed, do upgrades as we deem fit for specific units to get the premium rent amount that we can for that market. And then we talked about playgrounds at the beginning. There's a lot of kids here, as you can imagine, being close to middle school and an elementary. So we want to make some amenities for those kids that really enhance the quality of life for not only kids, but parents as well. And picnic areas, we're going to ask them what they want, what they need, and try to come up with a solution that we feel like is best suited for this property. And then our exit plan, year 5. So this is a 5-year hold. We want to ultimately look to sell in year 5, which if you know anything about commercial real estate, that really starts in year 4. It takes a while to market and get something under contract and get to close. So we're going to be looking to sell, return to capital, and then share profit. Of course, throughout all of this, we plan to do quarterly distributions to our investors. Again, 8% preferred return. And we'll talk specifically about that split here in a minute. Mention light upgrades. So you can see here the picture on the top, the 3 pictures on the top, that's a classic unit. Not bad, but opportunity to reface those cabinets, upgrade countertops, just do some cosmetic improvements. You can see the unit on the bottom is exactly that, right? They've refaced the cabinets. They put in some countertops that are nice, that are durable, just upgrades. And some new flooring, probably some vinyl plank. And we've budgeted for most of the units to go through some sort of upgrade. And again, we'll triage those as they come up, and we'll determine what needs to be done. And we have a great partner in place to do that work fairly quickly. So let's talk about investment returns. Ryan, if you're willing, do you want to jump in here and talk about returns?
Sure.
Cool.
Yeah, so we our base case is what we expect with occupancy where it currently lies. So we're anticipating a 17% average annual return with an 8% cash on cash annualized. Obviously, that's because of the preferred return. The actual cash on cash during years 1 to 4 will be between 4 and 6%, depending on operations, and then the balance will be made up at the sale to make that 8% whole, which will deliver an equity multiple of 1.85. So on a $100,000 investment, we're expecting a projected return of 85,000. So total return to the investor of 185,000. Additionally, based on some initial quotes we've gotten for depreciation at accelerated depreciation and cost segregation, we expect basically a taxable loss of around 22,000 or 23,000 for a $100,000 investment, and that's currently at the 40% bonus depreciation. There is talk of president working to get 100% bonus depreciation back in play, retroactive to January, which would be very beneficial for us. So that number would go up.
Yep. Yeah. Thanks, Ryan. I think that's actually one of the key benefits of investing in multifamily is the accelerated depreciation and tax deductions through cost segregation, something that we really appreciate, and I'm sure other investors do as well. And if you want to know more about that, we're happy to talk about it in detail at a later time. So we showed kind of the risk-adjusted version of the returns, and that's at a lower occupancy. That's black swan events like another COVID. How do we mitigate risk? And so we have a fixed rate loan. I mentioned at the top of the presentation that a lot of people right now they're having to give their properties back to the bank, and we're seeing that specifically within the last month more and more. And the reason is because they took floating rate debt, and that debt is maturing. They took it at 3 or 4%. It's maturing at 7 to 8%. They can no longer cover the debt, even if they have a really well run property. It's very stable. It's good property, and it's an unfortunate situation. We have never taken floating rate debt, but we feel like fixed rate debt, if the property works at a fixed rate now, that it'll just do even better in the future. But we want to also take advantage of a lower loan to value, so lower leverage. So we're using 60% LTV. We're working with Freddie Mac, which is agency debt, is what they call it in the business. It's a really good debt structure, 30-year amortization, fixed rate, and but we're using 60% of that. So the rest of it's equity. So the reason we're having this call is to raise the equities part of the debt. And the reason that's important is because, again, if something goes wrong, like people are experiencing today, we're not over leveraged. We can actually manage through maybe a season of difficulty or challenge because we have lower leverage. So in those scenarios where you have high leverage, something happens and you can't pay the debt service, then the bank's going to step in. So we want to mitigate that risk by doing lower loan to value. We have we have cash reserves, not only for CapEx contingency, this being a bit of an older building. We want to make sure that we have reserves in there to take care of things that come up without needing to create an insurance claim, which little things like let's say a unit toilet floods and we can just repair the drywall and it's only a $3,000 or $4,000 fix instead of doing a big insurance claim. So we want to have our own little insurance contingency fund, and then of course operating reserves. So we want a year of reserves $250 a unit for to just make sure, like, for example, if we have a COVID event, people can't pay rent, or we do, rent becomes suspended, again, those black swan events, that we're able to leverage our reserves. Again, if we never use these reserves, it goes back to all of our investors in the end, but it is something we do to mitigate risk there. Also, we're boots on the ground. Our company's based in Austin. We can be to this property in 2.5 hours or a 45-minute flight if need be. Our property management partners are there, boots on the ground. They actually manage a property just down the road. So it's a benefit to have people near the asset and checking in. We actually have on-site management. In fact, we're probably going to have the person managing the property is going to live there. So that's even better because they have eyes on the property at all time. And as we talked about before, we're going to immediately address some of the deferred repairs that need to happen: roof repair, sewer, boiler. We're going to do those day one, so we can mitigate any further needs that occur from those repairs needing to happen. And as I mentioned, we have a really awesome property management partner. We have vetted them. We've talked many, many times. They actually helped us with due diligence on this property, so they know exactly where this property is, what condition it's in, what needs to be done. They're talking to the current property manager, so and they have tons of experience in this specific asset class and in this area of Fort Worth. So you can read things that are going on here. They've even come to us with some ideas of how to add value to this property, how to be more efficient in managing it. And one of those is integrating the technology that they use. So we're really excited. I think we're going to see even more ideas come up as we kind of get in and start working with this property and working with the residents. So I'm excited to work with Gateway. They've been on our calls in the past, and so if you want to reach out to them, happy to provide their contact info. All right. I mentioned this at the top. So Fort Worth. Fort Worth is experiencing growth. Bottom line, they are. It's a cool town. I lived in Dallas my whole family's from Dallas. My parents grew up there. Fort Worth's always kind of been this smaller little, like, bit of an overlooked town connected to Dallas. It's always been the DFW, but Dallas is always kind of getting the attention, and I think Fort Worth is having its moment. It's different than Dallas. It's always been a bit smaller, a bit more. I don't know how you say, but just slower pace there than Dallas. But I think right now it's experiencing a lot of growth because people are realizing how much of a great city it is. And you can see some of the stats here. It has great infrastructure from an investment standpoint. So population growth equals demand for housing. Diverse economy equals places for people to work, especially in the workforce community, blue collar, the trades. And, there's been supply, but most of that's been north of Fort Worth and what they call the mid-cities area, or north and east, and not really much in the south or southwest. So, occupancy has remained strong in that area, whereas some of the Class A properties have seen a little bit of a hit from the supply. We're not seeing that in workforce and in the southwest area of Fort Worth. So I mentioned where this is. So it's inside the 20 loop, southwest Fort Worth. That's where it's kind of positioned if you're familiar with Fort Worth. Dallas is, of course, over there on the right, Fort Worth on the left, and everything in between we call the mid-cities. Arlington's probably the most identifiable. That's where the Texans, that's where Dallas, the Cowboys are, the Rangers, Six Flags. So those are kind of identifiable. So this isn't far from that area either. If you look at it on a map, kind of this aerial view, you'll see downtown Fort Worth. Texas Christian University is not too far. And then I mentioned, elementary and middle school, not even a block away. Well, maybe technically a block away. And Vista Del Sol, as we mentioned in the top, one of the reasons we love it, and I think why it remains a stable property with high occupancy, is it's really one of the only apartment complexes for this affordable, affordable housing in this single-family neighborhood. And there's not much else around. And so if you want to be close to this middle school, if you want to send your kids, down the street, and you can't afford a single-family house, or you can't afford to rent a house, then this is really your only option. You can see to the left, there's Southwest Baptist, the Theological Seminary, which has been there for a long time. Originally, this was housing for that seminary. So again, it was built as a very unique purpose with serving that seminary, and now it's serving this community in a way that is very unique, and I think a very good strategy for ownership and operations. So that's pretty much it. That's the big overview of Vista Del Sol. It is, again, I think a solid investment that's providing both cash flow, income. It is, in a great area, a growing area. I think, when we sort of used what we call best case scenario, which, we don't really advertise that or talk about it, but it's like if everything goes towards what the forecast is saying, rates, cap rate compression, supply tailing off, demand going up, we feel really strongly and confident that this is going to be a solid investment long term for those 5 years. But our base case is what we're projecting here with these returns, and it's still a very solid investment, especially if you are somebody who can take a benefit from the tax depreciation or the tax savings through accelerated depreciation. So the two things I do want to mention is we're set to close on this property towards the end of the month. And so this is our last round of engaging with investors, specifically accredited investors. So we did a friends and family round. We converted this to a 506C so that we could put this out to the broader investment community. And so we're looking for commitments fairly soon. We have some room left in this deal. We've raised capital. We have a little bit more capital to go to have this fully funded. And so we're looking for commitments fairly soon, May 20th. And really how you do that is by indicating a soft commit through our website. I'll show you that in a minute. And then we're looking for capital contribution by May 25th, 26th, 27th. We're kind of flexible there, but trying to get it done by the end of the month. And so if you're interested, just scan this QR code, or you can hit that link. And basically that's our investor portal. You can review the offering, all of the subscription docs. There's some due diligence in there. There's a deck. We'll have this video in there. And there's ways to contact us if you want to talk in more detail about this investment. And that's how you actually fund your investment. So you have to sign up for the investor portal, and then that funding the investment, signing all the docs, everything happens in that investor portal. It's pretty sweet. And one other thing is, if you want to use a self-directed IRA or a retirement account that is eligible for this type of investment, that's awesome. We have a lot of investors doing that. It makes sense right now when there's a lot of volatility in the market, but that takes a little bit of time. So let us know if that's the direction you want to go. If you don't have a custodian, we can make some recommendations, and we don't get any money or anything in return. I know some people that can do it really quickly and are really good when it comes to self-directed IRAs or solo 401ks. That is pretty much it. This is what our investor portal looks like, just so you know. There on the right, if you're not signed in or not logged in or don't have an account, that's where you can create your soft commit, and we'll engage with you once that happens. And thank you. We really appreciate your time. We appreciate your paying attention, and we'll create some space for questions. Of course, you can ask us here, or you can email us, reach out to us directly. Happy to take as much time as needed. to answer those questions. So everyone, have a great day. Appreciate it. We'll talk soon.